Hey, everybody. So that was a really great presentation we just heard from Samantha. Interesting, especially when they were talking about selling options at the end there for income, because that's exactly what Trading Trader's been doing since 2008. So I'm going to go through a presentation. I've got a lot of live trades that I am going to share with you as well. This is a presentation I titled A Proven Comprehensive Option Strategy to Scrape All Those Trading Pitfalls. See, we like to trade on time passing by, just generating income off the options market. So you can spend your days decorating for the holidays. So let's get right into it. First of all, I like to take a little bit of kind of throw out the facts, right? You've been hearing about them all day. There's a lot of uncertainty with what's happening right now in the world. But the one thing that is a for sure is if you play the markets right, you can be set up for months, if not years to come. And you have to remember that despite what the talking heads say, where they're like, hey, today this much money was generated in your market, or this much was lost in the markets today, the markets are just a place where equities move from one hand to the other, right? Trades go from one hand to the other. Money is not created or destroyed. It's just moving from one hand to the other in the market. So the key is making sure you put yourself on the correct side of that equation. So that's what we're going to be doing here today, talking about how to always be on the correct side of that equation. Let me ask this, because I can tune my presentation today a little bit. Are you here because you want to learn how to invest for low risks and high returns? In other words, you want to learn how to fish and be 100% self-reliant? Or are you here because you want to learn how to invest, but be around seasoned investors reviewing your investments before you make them? In other words, you want to learn how to fish, but you want to have expert fishermen around you, so that you can kind of pick up on their tidbits. Or maybe all you want to do, you're not, you really don't want to embrace this at all. You just want to be grouped in with expert fishermen to follow what they're doing. I say fish along expert fishermen and do what they do. Or maybe you're here for some other reason. Just let me know in the chat whether you're an A, B, C, or maybe D. That way I can tweak my presentation accordingly. I'm going to keep on going and I'll look at the answers. I've got the chat up in front of me, so that helps me understand. Okay, what I wanted to do when I was embracing investing, and I've been doing this since 1997, is I really wanted to create consistency. And what I wanted to be able to do is double my income every year. So here's the scoop. I focus on 6% every month. Now, I surpass that in my portfolio, by leaps and bounds. I get into the double digits, but I focus for every single one of my trade on and deciding as to what my next steps are is, am I going to get 6% this month? Because if I focus on growing 6% every month with all my trades, then my portfolio is sure to double every year. Now, I mentioned that my program participants and I do better than that. We do double digits every month, which means we are doubling our portfolios about every 5 to 6 months. But again, aim for the moon, maybe you'll get to the stars. If you're focusing on that 6% and that's the target you hit, then you have $1,000 portfolio. And a lot of my program participants, because we're talking about options, are starting with, 800, 1,000, a couple $1,000. It's going to double, be more than $2,000 in 12 months. In 2 years, that means it would be a $4,000 portfolio. 5 years, you're talking $33,000. And at the end of 10 years, you're a bona fide millionaire. In fact, this is the recipe I followed. I didn't quit my day job with Hewlett Packard. I was a high-level engineer slash marketer with them until 2005. I started doing this in 1997. So the scoop is I grew my nest egg through options investing and options trading until it got to a certain level. Because if you have a $100,000 portfolio that you've generated, now every year that portfolio is going to generate more than $100,000, which is fantastic because the mean, actually it's the median, you got to get your statistical terms right. The median income here in the United States, and it's been pretty flat. It's been growing slightly more recently, but it's $87,000 for a 60-hour a week, work week, right? And so 60 hours a week. What I wanted to do was have my money working for me so that I could spend time during the days doing something else. So this is, if you can grow your portfolio to a certain critical point and have it be that golden goose, it can now lay golden eggs. And we've got it to a point now where our portfolio just grew to over 8 figures, right? Because we've just, whatever we don't use in expenses, we reinvest for the next year. And so it just keeps growing because our expenses are not nearly that big. All right. So what are we actually investing in? Well, we're selling theta decay optimized option premium. Now you're saying, AJ, that's a lot of freaking word salad, isn't it? Well, here's the scoop. Let's break it down. What we're doing is profiting on time passing by. Now, when a lot of people talk about options, they think about stock substitutes, and that's one way to use options. But people forget how useful these derivatives are, right? Options not only are influenced by the underlying symbol price, but they're influenced by all other kinds of variables, including that clock to expiration, which is what we're really emphasizing on. And before I go forward with more of my presentation, I just want to make sure you picked up on a key point. Now, what minimum returns did I say you want to be focusing on in your portfolio monthly if you want to more than double your money annually? Was it 0.5%, 1.5%, 5%, 6%, 10%? Which one was it? Do you remember? Okay, I see the answers coming in through the chat. Absolutely. If you wrote down 6%, that is the answer that you want to be focusing on. And if you didn't get that as your answer, write it down now. That's the key. You want to keep that in your mind all the time. So now, what about those folks that say, okay, AJ, you're talking about options. Aren't they risky? Well, think about equities, whether or any investment, really. Equities, commodities, foreign exchange currencies, cryptos, antique cars, paintings. Most of the time, what you're trying to do is buy low, sell high. So that's one strategy, right? If you're, have some thoughts behind it with commodities and with equities, you could actually have accounts that allow you to short them, which means you sell to open, buy to close, make money on the way down, right? So you heard about a lot of the folks who were involved with that whole GameStop and AMC a few years back. They were actively shorting those companies when all that shenanigans happened. So that's two different strategies. But with options, right, we can also make money if the stock simply goes sideways. And a lot of stocks, if you pay attention to their patterns, they spend a lot of time going sideways. In fact, I search those out with my screeners. You can also make money with options on that timer passing by. And there's also the component of if there's fear in the market, option prices are going higher. That's called an implied volatility rush. And if there's confidence in the market, you can make money that way too on a crush. So there's so many different influences to the options price. Mathematicians, by combining options into different strategies and or just how you select them, the strike price and the expiration date, you can get them to respond to any pattern pretty much that you can identify in the markets. Last time mathematicians really looked at it, I just read a white paper on this, they came up with not one strategy, not two strategy, but 27 different ways that options can be used to profit on the market. So are they risky? I would actually argue with all of those different ways to profit from them, they're the opposite. In fact, the market movers, the ones who actually like pension fund, mutual fund, hedge fund traders, they use options in order to hedge against risk, not because they are risky, right? What is this thing? There are some of you on the line that probably are like, options. I keep hearing about options. So nerd speak here. Financial instrument called a derivative. They're typically bought and sold to hedge against risk because they'll allow you to create protective, protective risk stops, if you will, against stocks, indexes, ETFs. But that's not really what we're doing here at Trading Trainer with our program participants. What we're doing is we're selling their premiums in order to generate income, right? Now, before I go any further, let me just make sure you guys can get more information for me. I have a tendency, because I'm more than, I'm actually teaching during these things. I tend to, if you follow this link, or just write it down for now, it's links.tt4.me. You'll come to a quick link page that looks just like I've got on the screen, where you could check out our free indicator suite. You can check us out on all of our different socials. We've got a YouTube show we do every Saturday morning. We've got all sorts of freebies. I've got all sorts of white papers and articles you can download. We've got a daily workshop. We've got programs, we've got coaching. You could just check out the company I founded, Trading Trainer. So just write this down. You'll also be able to contact us if you'd like to contact us from this page. So links.tt4.me. All right, a little bit about me. I founded a company called Trading Trainer all the way back in 2003. They often call me the world's most disciplined option trader. I actually think my peers behind my back call me the laziest options trader. I like to think about myself as the most efficient option trader. That's because options trading for me is not something I do because, I'm way into it. I mean, I've always been interested in it, but I do it as a source of actually growing my portfolio. And I do it so that I minimize the amount of time and effort. I'm considered an end of day trader. And that's because even though I'm 51 years old, and I hope some of you are saying you don't look 51, but even though I'm 51 years old, I have a 3-year-old. And I like to spend as much time as possible with this little chick as she's growing up. And so I'm not going to be sitting in front of the computer all day. What I'm going to do is wait until she's gone to bed. And then at 10 p.m. at night, I'm going to spend 30 minutes evaluating my positions, evaluating my watch list, deciding what actions I'm going to take to the next day, and then program the trading bots to do that while I spend my day doing other stuff, fun stuff. And that's the lifestyle I've created for myself. And that's what options have allowed me to do. And also nowadays, all these new trading bots that you can program. I've been doing this since 1997. I started Trading Trainer officially in 2003, but in 2002, I started publishing this newsletter that I've been doing every day since 2002. And there's an ebook that you'll find on a lot of options traders' hard disks that I wrote in 2005 called The 7 Strategies of Successful Options Trader. It's become a staple for many options traders. Also, you might see on their bookshelves my home study course that I created all the way back in 2007. The key thing is though, I'm always been a learner, just like most of you. I went to university in the early 90s, late 80s. I got a whole bunch of degrees in engineering. And then I went on to get a whole bunch of additional degrees in commercial business and investing. And in the last 15 years, I've really been focusing on how to be the best teacher, because I want to be able to convey this information to others, especially others that are no longer in the school age where your brains are really plastic and you just suck up everything. I've been learning how to teach folks that are, my age, that you have to teach them differently, right? And also, one thing I want you to know, just so that you realize we're on the same page, is that when I first started out, not only did I spend $27,000 on seminars, and that was a lot in 1997. It was a good thing I was single and I was renting a house with a bunch of guys, so the rent was low, and I had a pretty good job in Silicon Valley working for Hewlett Packard. But $27,000 was a lot. That was like how much my first degree cost from University of Virginia. But I also wound up giving $85,000 back to the markets, trying to follow some of these stupid. And back then we didn't have Zoom, right? We used to actually go for a half a day on Saturday to some free thing in a hotel, and then you'd pay a couple $100 and you'd come day for all day Sunday, and then you'd come back, you'd wind up, you're on a plane and you're going to some destination in order to spend a week with some of these people. Some of you might be old enough to remember some of that stuff. I did all of that. And I'll tell you, I don't recommend you doing it my way, the trial and error method way, where you kind of try to find these things. Here, write this down. This is on a tangent from the whole options investing. This is how to crack the code and be a successful investor. And I'm guessing that if you're tuned in, you're trying to figure out how to be the most successful investor you can if you're tuning into David's shows and things like that and this event. Number one, stop chasing shiny objects. That's what I had to learn how to do. You want to settle on one type of investing and learning it well. You know, whether it's options trading like what I do, or, you know, big ETFs, or, you know, futures, whatever it is. And what I suggest you do is pay attention to what your lifestyle is all about. Okay, because that's what's going to dictate. If you can't be a day trader, then don't spend your time trying to master day trading if you can't be there, because day trading is all about the right timing of everything, and you have to be there at the right time. And if you're like, well, sometimes I can be there, but other times I can't, maybe day trading is not for you, right? So figure out what would be the best to fit not only your dream lifestyle, but what your lifestyle is now, and then just learn it well. Don't get, so many of us are so good at marketing, right? To get you to sign up for things, but put up the shiny object, you know, force field and settle on one thing and then just master it. That's number one. Number two, hire a mentor who is currently doing what you want to be doing and knows how to teach. You have no idea how much money I have spent on folks who clearly, they used to show me their portfolios. They were doing exactly what they were doing and they were super successful, but man, they could not convey their information to me and transfer it so that I could do the same thing. And that's not going to do anybody any good, right? So make sure that's the type of person you pick. And that's called, by the way, in like nerdy teacher speak, it's called learning by guided discovery instead of trial and error. Trial and error took me close to 6 years and I lost for that long. And that's a long time. It was a good thing I was in my 20s and my early 30s. But in guided discovery, we can get folks, you know, on the right path in a matter of months, right? If not weeks. So try to do that. Finally, this is number three, join an investment group. Look over each other's shoulders and, for gosh sake, leverage with pride. That means, you know, if somebody's doing a good trade and they've identified a ticker, they don't own it. You should do that trade too, right? You know, I'm so worried that my little one, when she goes into school, that they're going to keep hammering into her head that thou shalt not cheat. When I worked at Hewlett Packard, what we used to do is buy, every time Canon and Epson would release a new printer, we would buy it and our engineers would take it apart and figure out one or two things that they could incrementally improve on. And then that would be our new printer that we would take to market, right? It's called leveraging with pride. It's how we move forward. And by the way, if you have really good trades, let other people do them as well. It's not something that you're going to hoard. There's enough for all of us to go around. And finally, surround yourself with like-minded investors. Like in our program, we get everybody together. And the reason is because when you have wins, you want people to celebrate it with. And when you have losses, you want people to say, hey, I had some losses. It's no big deal. Just keep going, right? Because otherwise, you know, you surround yourself with people who are like, why are you spending your time learning how to trade options? Right? And they're like naysayers. They've never done it themselves and they haven't had a successful day in their life, but that little voice gets in your head and then it sabotages you. And by the way, these 4 things is exactly what I did. But again, it took me 6 years to figure this out. I've just given you the list. I hope you wrote that down. That's how you crack the code. Okay. One last thing about me, and then I'll get back to our option trading. I have a foundation that I started back in 2003. And we take historically underserved inner city kids off the street, and I teach them the same exact program that we offer at Trading Trainer. These are a picture of the first 9 kids that I worked with. And we did take some time off during the pandemic, but we're back at it every year. And we've partnered with the CBOE. So we are taking kids mostly out of the south side of Chicago. Last year, we graduated over 130 of these kids. So that's where, that people ask me, why do you do this? Well, I teach people so that I can then take all the profits from my company and put it into this foundation, because this foundation will last and live on way past AJ Brown, right? So this is my legacy. So that's kind of why I do all of this. Okay, back to the topic. How do we sell premium? We're going to focus on 4 simple transactions. Write these down. Going to write covered calls. We're going to write covered puts. A lot of you probably have heard of, if not have done, covered calls, but I bet there's very few of you that have done covered puts. I recommend, especially with, what I think is going to be happening in 2025, 2026, that you have covered puts under your belt. And we don't have enough time for me to go into covered puts in detail today, but I want you to, either, check out some of my white papers on the topic, or, YouTube it, whatever you have to do, get covered puts as a strategy under your belt. It's flipping the covered call upside down. Same with supercharging this. We can take the covered call and we can replace the covering position, the underlying symbol, with a substitute option. That creates, for the nerds out there, the academicians, a bull call diagonal debit spread. I just call it, a supercharged covered call. And finally, the 4th strategy is a bear put diagonal debit spread. That's our supercharged covered put. Again, replacing the shorted stock in that equation with a deep in the money far out in time put option. And mark these 3, the covered call, the bull call diagonal debit spread in position 3, and the bear put diagonal debit spread in position 4 as cash trades. You can do them in a cash account. You don't need any special account. In fact, a lot of my program participants do these trades in their retirement accounts, which are cash accounts. This guy over here, writing a covered put, does require a margin account. So just know that. And also know that these 2 guys are analogous. So if you don't have a cash account, but you want to take advantage of the pattern, then you do this guy. You write a covered put against a leap. You supercharge your covered put, because this is actually a cash trade, but it still profits from the same mechanisms as the covered put. Got it? All right, let's keep going. So I keep mentioning this word option premium. So when you look at the option price, when you look at the big board of the CBOE and you watch those option prices going up and down during active trading hours, realize that every option price has 2 components: an in the money or intrinsic value component, and a premium component, otherwise known as the extrinsic value. So the in the money plus the premium value will equal that option price, or you can reverse it. You could take the option price and subtract the in the money value and you'll get the premium value, right? Just move that around. So it's that premium component, by the way, let me bring my cursor over here and just underline that I am focusing on when I'm wanting to profit from options. All right, so last night when I was preparing this presentation, I looked up Ford. Ford closed last night at $10.73 a share. So let's say we buy some Ford and then immediately sell the Ford December $11 call. So that's the call option that's going to expire on the 3rd Friday of December, December 20th, and it's the $11 strike price. I'll immediately get 26 cents back. That's going to reduce my break-even price on Ford, right? It's basically, I'll be buying Ford stock shares at a 26-cent discount right away. That option is also going to act like an expiring coupon with an expiring date. So as I get closer to that expiration date, I'll get to realize the full value of that option. It's also, options are sold in lots of 100. They're called contracts. So for every contract of that, December $11 call that I sell, I'm going to make 26 bucks. It's like an instant dividend. It's not a dividend per se that the company issues, but it's like an instant payout to the investor. All right, let's run through some scenarios. First of all, what happens if on the third Friday of December, Ford is trading above $11? Well, okay, we paid $10.73 a share. We get $11. So we make a 27% per share profit there. Don't forget, we also collect 26 cents up front. So we wind up collecting 53 cents per share of Ford. That's a 5.1% ROI. Nice. But here's my more desirable situation. What if Ford is flat? It doesn't go up or down. So I spent $10.73 on Ford. I collected that 26-cent instant dividend up front. I keep that 26-cent instant dividend up front. I've made 2.5%, but now I still own the stock, so I can do it again for January and February and March, right? I'll do it again and again and again. I like this because it's one trade a month, right? I'm selling, and then on the third Friday of the month is payday, and then you just look to do it again. And you can do it as long, most of my participants are in these trades for, on average, 5 months, but some of them go as much as like 6, 7, 8. Some of them get exercised in 2, 3, 4. But just think about, having this trade and every month putting a trade on and collecting an income off of it. Now, of course, people are going to say, well, what if Ford drops? Well, I am going to show you a method just in a couple of minutes on how to reduce our risk on return even further. But just know, built into this strategy, if we paid $10.73 for Ford and got that 26 cents back and reduced our break-even price, that creates a profit buffer. In other words, Ford has to drop all the way down below 1047 before we're even in the red. So we create a profit buffer. In addition to those other things, the instant dividend, the expiring coupon, the discount on the security, another effect of this strategy is we create a profit buffer. Let me show you actual trades, and I'm going to actually show you a trade. Speaking of Ford, this is one that my program participants and I have been doing. First of all, it started on January of this year. We bought 900 shares, or I bought, this is mine, 900 shares of Ford, just over $10,000 investment. And then I wrote my option. February 16th, I wrote my option for 23 cents. April 9th, I wrote it, got 80 cents. April 26th, 35. June 3rd, 45. July 9th, 26 cents. And then I was exercised. So for that whole time, I wound up walking away with 37.1% ROI. But guess what? It wasn't that far after where I just opened the trade again. This time, again, 1,000 shares, about $10. Again, a $10,000 trade. And then in August 28th, 37 cents. I came back October 22nd, 32 cents. November 18th, 26 cents. This is the one that I'm currently in right now. I'm waiting for it. This is the December 20th. This is the option that expires in December. But I went ahead and put in the values of if I were to cash this out. And again, I made this presentation last night. So with last night's closing prices, if I cashed out, I'd be up 16.3%. Of course, I didn't cash out. I'm waiting for this to expire. It looks like it's going to expire worthless, at least as of now. And I'll just keep doing it until I get exercised, right? That's kind of the beauty of this strategy. All right. Let's make sure we're all on the same page. Answer all of these that might apply. What does investing by selling options premium create? Does it create an instant dividend? a discount on a security, a profit buffer, an expiring coupon. Which of those do you think this does? The answers are coming in. If you said it's all of them, you're absolutely right. And if you didn't say that, just take note. It's all of those things, right? Now, I'm going to start, the questions are going to get a little bit harder, and I'm going to ask you to think about them in advance now rather than in reverse. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? Should we sell out in time options, farther out? Should we replace the security with options trading at parity? Should we just give up? This is silly. We should buy mutual funds. Or is what I'm talking about not even possible? What do you think? Some of you are thinking sell out in time options. Actually, we don't want to do that. There's diminishing returns the farther you go out. That sweet spot is no more than 5 weeks. It's 3 to 5 weeks, sometimes a little less than 3 weeks. But going farther out, the time that we spend in the trade doesn't result in better returns. It's better to do like 2 3-month 3-week options, one back to back, than to do a 6-week, right? Now the answer is what we're going to do is replace our underlying security with an option trading at parity. We're going to supercharge this. So you might be saying, AJ, option trading at parity, yet another term. So option premium we've talked about is the most when the option is at the money, meaning it's close, the strike price is close to the current trading price of the stock. But when we go very deep in the money, the option winds up with very little premium. This is how options change their personalities. It's almost completely intrinsic or in the money value. Okay, again with the word salad. Let's see if we can break it down. Deep in the money options behave just like the stock or the index or the ETF. In other words, they move dollar for dollar. If Apple stock gains $10 in a day, then the deep in the money option will gain $10 too. It's a perfect underlying security substitute, stock substitute, but it's at a cheaper price. That's what we like. Includes a little bit of leverage in there. Now, these options that are deep in the money also have expiration dates. How far out should we make sure that they expire? Well, I already mentioned that we need to, collect premiums against these things. And on average, my program participants are going about 5 months, but some of them go 6, 7, 8 months. So let's go at least 8 months out. That way, this thing will stay put and we'll be able to sell up to 8 months of premium against it without it expiring. It's almost like you have a house that you're renting out every year. The last thing you want to do is have this house all of a sudden disintegrate so you can't rent it out and get that income anymore, right? So that's what we're going to do here. We're going to make sure these options are at least 8 months out. So, and just as a side note, the leaps, those are the ones that expire every January. There's usually leaps at this point out 2 years. We've got leaps in most cases out to 2026 at this point. Those have some good liquidity on them. And one of the things we want to do is make sure we trade options that have liquidity. So sometimes we may even go farther than 8 months just to use the leap. So let's come back to our Ford example from last night. So I talked about $10.73. If we would have bought Ford last night at close, that's how much it cost. But if we wanted to, we could substitute this June option that expires in June of 2025. It's a weird strike price, and that's because Ford did these one-time dividends that messed with the strike prices. This thing has a strike price of $7.17. And it was only going for $3.75 at the close of last night. So we could use that, and it's going to act exactly like Ford. If Ford goes up $1, so is this back month option. And this particular option, it just about matches our definition of having 5% extrinsic value. So instead of using forward, we're going to buy this call. We'll sell that option, that $11 call right there, 26 cents. Get that instant dividend, reduce the break-even price of our back month option, all of the things, right? Act like an expiring coupon. So what happens if forward's above $11? Well, we paid $3.75 for this substitute option. Now you're probably wondering, where did we get $3.83? That's why it's called a spread. It's the difference between the strike prices. So when you get exercised, instead of getting the $11, you get the difference between the $11 and that back month option. So you get $3.83. So we made 8 cents of profit on this candidate. But don't forget, we also collected 26 cents of profit per share up front, which means we get 34 cents or a 9.7% ROI on what we invested. Now, that's some numbers I can get behind. Now, what if it's flat? Remember, this is more desirable because then I can keep selling premium every month. So I paid $3.75. I collect 26 cents. I get to keep the 26 cents. 7.4% ROI, also a number I can get behind because I'm trying to get anything above 6%. And I get to do it again and again and again, just like clockwork. And of course, what happens if Ford goes down? Well, we've got that built-in profit buffer of 26 cents. In other words, that back month option would have to trade all the way down below 349 before we're even in the red. It creates a profit buffer. Now, again, I got to show you some trades that we did. This is one that my program participants and I, this was on AT&T. And AT&T, I would have rathered buy the back month call option. So that's exactly what I did. Paid $6.05 a share, 20 contracts, wind up in my portfolio being an investment of a little over $12,000. First month, got 13 cents a share. Second month, 38 cents a share. Next time, 22 cents a share, 31 cents, 45 cents a share. And finally, I got exercised for $8, right? So in this first run, from November of last year until June of this year, I walked away with 73.7% ROI. And then, of course, I picked the trade back up again in September. That's what's great about these candidates is a lot of times you get exercised, you just come right back in. I bought 472. This time I'm doing 22 contracts. $4. I've already sold the first premium, 31 cents, expired worthless. The second premium, 40 cents. It expired worthless. I'm looking to sell the December premium. I haven't gotten the signal yet to sell the December premium, but that'll be coming in the next couple of days. Last time I sold premium was on Halloween, so over a month, just under a month ago. But last night when I was putting together this presentation, I said, well, what if I cashed out right now? And it looks like I'd be walking away with about 16.9% ROI. Not bad for just a couple of months of work. I want to remind you that we're focused on 6% because that doubles our portfolio every year. Now, last part of the puzzle. How can we drastically reduce our risk on return? Because yes, there's that profit buffer, but we want to, nip that risk in the bud. Should we be focusing on half as much option premium? Maybe that would be the answer. Again, maybe we should sell farther out in time options. Maybe we should collar the investment by marrying a protective option. Or is what I'm talking about not even possible? What do you think? So we want to add that protective option. And the best time to add that protective option is at the same time we sell premium. When we sell premium, we actually put ourselves under an obligation to perform until that expiration date, right? So when you have that obligation, right, it's good to add insurance. It also, if we wait until that point, the insurance becomes a point where it's a profit center to our economics of our position, not a cost center. A lot of people put these hedges on to their trades, and they put them on fully expecting to lose money on them, but being protected. Well, what we've done by adjusting how we time these trades is we've actually created an additional source of income. Let me show you in a real trade. This is one of my favorite. This was a trade that I did back in the day, but it just shows this point so perfectly. We did 600 shares of Pan American Silver, and then you'll notice we sell the premium and then buy our protective put on the same day. So I sold premium for $1.76 and then bought a protective option for $4.75. Fast forward, the premium expires. Now, if the premium expires, I really don't have to insure the position anymore. I could just use a bailout or a stop loss order. So I look to sell the protective option back. So what are we doing here? We've actually added an additional transaction every month. So instead of trading just 1 day a month, I'm trading 2 days a month on every one of my positions. Again, you program this into the overnight trading bot and it's like no big deal. So, but check this out. I made $1.76 because it expired worthless. And then when I rolled over that protective option to the next one, I bought it for $4.75. I sold it. It provided me all that protection from September 1st through September 24th. And in addition, when I sold it for $5.90. So in addition to the $1.76, I also made $1.15. It's like frosting on the cake. And then I did it again. $1.47 the next month. I bought the protection for $3.01. And then when I didn't need it again, 28 days later, I sold it for a profit for an additional 61 cents. So now every month, instead of generating one source of income, I'm now generating a second source of income while also protecting my position when it's at its most vulnerable, whenever I have premium sold. And I just keep rolling those positions out. The next month, $1.50, $1.20, and then I got to buy that, sell that protective option for $3.07. And I just kept going and going. But here's the other thing I want you to notice. Notice my protective option has a strike price of $34. And watch this break-even price. So in the first month, my break-even price, when all the trades are done, ends at $31.86, never to go above $34 again. So what does it mean if I'm protecting something for more than it's worth, more than its break-even price? Think about that. What does that mean when you have a trade where you're guaranteeing a payout if it goes against you that's more than the current worth of the trade? Let's talk about that. This is that exact trade on Pan American Silver. And what I want you to notice about this trade is that there's my break-even line. And I want you to notice that there's this range low and this range high. This is if the underlying symbol goes in your direction or against your direction. And this is where people get confused. They're always asking me, well, what's your win-loss ratio? And my win-loss ratio is based on the time, the clock ticking down. Because as you can see, if the underlying symbol goes against me, so long as I've been in the trade a certain amount of time, I still make money. See, if I'm in the trade my usual amount, about 5 months, whether the underlying symbol goes for me and gives me a 65% ROI or against me, and I still make 50% ROI, I actually don't care. I don't care if the symbol wins or loses because my profit mechanism is that option timer ticking down. And as long as I let it tick down a certain amount, that break-even price drops below my risk level, it's a risk-free trade. I'm guaranteed returns. So the key here is usually between the first and the second cycle, you have to have your position go at least one cycle. And then it doesn't matter. You're dealing with only the house's money. You're not dealing with your own money anymore. Your money is risk-free. So we just aim to have all of our positions at least go 1 month. and then it's just profit no matter what happens to the underlying symbol. The underlying symbol could crash or it could shoot to the sky. We're guaranteed our profits, which is what I like to count on. I don't like to go to bed white knuckling, wondering whether or not my trade is going to do good the next day. I like those ones where I don't have to think about it. On the third Friday of every month, I get my payday. All right. So let's review. What do we have when our cost basis, our break-even price, is less than our protective bailout price? Do you guys remember? Did you pick up on that? Is it a risk-free investment? A losing trade? Too much complexity? It can't be too much complexity. I'm talking about doing 2 trades a month on a position. It's not a pipe dream. Am I smoking the crack pipe like people did in the 1980s? It's a risk-free investment, right? All right. Let's review those 3 steps one more time. Ready? Got your pencils ready or your pens, or if you're taking electronic notes, you got your typing fingers ready? We're going to buy or short an underlying security like a stock, an ETF, an index, or we're going to buy a substitute option trading at parity. That's step 1. Step 2, we're going to sell a near-term at the money option for its premium value. We're going to get an instant dividend. We're going to get that profit buffer. And then here's the key. At the same time we sell that option, we're going to collar with a married option 3 to 6 months out in expiration, and that's going to protect our investment. Now, you probably have noticed in my real life trades that there's actually some timing involved, right? So we look for, and I've got a screener that finds these candidates for us. I've actually got 3 screeners that look at the markets in 3 different ways. And we look for these sideways choppy, and you'd be surprised how many sideways choppy stocks there are at one time, even when the market's bullish or bearish. Like right now, energy stocks. Go look at Halliburton, Schlumberger, symbols like that. They're just ripe for the picking, right? My program participants and I actually went through Halliburton at a workshop earlier today. So you find these sideways choppy stocks, and if you're at the bottom, that's when you set up that initial covering position, is what we call it, the step 1. And then at the top is when you sell your premium and buy your protection. Your premium expires at the next expiration date. If you're doing monthly options, they expire every 3rd Friday of the month. If some of you are aware of weekly options, heck, you could be doing this every Friday. And then when you're no longer in the premium position, look to sell back your protective option. Rinse and repeat, rinse and repeat, rinse and repeat. And I told you about those covered puts. We didn't really talk about those today, and I'm urging you to go find out about those. Either come to me offline and we'll talk about covered puts, or go figure it out on your own. Covered puts, you're going to just find the same sideways choppy symbols. Start at the top. Yes, sell covered puts. Start at the top. That's when you short your stock or you buy that substitute put option. At the bottom is when you sell your put premium, buy your protective call. The put premium expires worthless. You roll out your protective option. So it's just done at a different timing than the covered call or the covered call on steroids. Figure that one out. Now, how would you like to never miss any of these picks, minimize the amount of time you spend away from your loved ones? Or it doesn't have to be a person. Some folks, like I have a lot of doctors and professionals who are so passionate about what they do, they don't want to spend time away from their career. Or some folks are into their hobbies. Like I have this one guy who's a scuba diver in Thailand, and he just loves scuba diving. So he's not going to be giving up any of the scuba diving to do this. So whatever your loved one is, and what if you want to always have support whenever you need it? Because that's what I'm talking about, right? Isn't that what it's all about? It's about saving time, creating clarity, and getting the results, right? So would it be okay if I take a couple moments just to tell you a little bit about my materials, my training, and my tools to see if they might be a fit for you? Cool. I want you to begin by getting your free indicators suite. Definitely go to that quick links that I gave you. Download the indicators, right? We've got definitely some more in-depth indicators, but start with those free indicators because that'll tell you when to do the different steps of the trade. The indicators just pop up with arrows. You can get them right there as well, but they're also in that quick links page. But consider letting me tell you more about this, because who is this program for? It's someone who doesn't want to pay for multiple data subscription. They want everything they need in one place. They don't want to miss any opportunities. They want to spend more time doing other things. They don't want to do this alone, and they want step-by-step instructions. In other words, the person that is attracted to me is someone who wants to get consistent and reliable results. Charlene, I got to tell you about Charlene. She was a teacher, right, for 29 years, and she got sick. She actually got cancer. And she stayed in the classroom as long as she could, but she got very weak, and they actually ordered her out. She had 13 years left before she got her full retirement. And she actually thought she was going to pass away. And this is where in the United States, if you're from a different country, this may not apply to you, but in the United States, especially back then, this was before the Affordable Care Act, um, insurance wasn't very nice to her. And she thought she was going to pass away. And she had come to peace with that. And she had a miraculous recovery and wound up with a ton of medical bills that were not being covered. And she had no livable retirement coming in. So that's when she found me. We started with a small portfolio. The rest is history. All she does now is she reads that daily table, the screeners, finds the stock that she's interested in, follows the strategy, and she uses this along with some of our other strategies. We've got some strategies around earnings season we like to talk about. She made 14% just by spending about 15 minutes reading about the company, following the chart, and then waiting for the expiration. So that's kind of what we're talking about here. So I got just a couple minutes here, and I'll answer any sort of questions. But when you sign up, you're going to get access to our portal. You'll also get a welcome call, a live person to show you through the program. But basically, I mean, we've got all sorts of things. We've got our tutorials on how to do this. We've got a once a month learning webinar where it's a lecture series, and we've got replays going all the way back to when we started this program, 2010. We just had the one from this Tuesday show up. We've got weekly workshops. People love these workshops because they come and they bring their candidates that they think they want to trade on, and they throw them at us, and we'll scrutinize them, and then we'll pick one and we'll actually plan it out so that everybody on the line can trade it. They have a trade plan by the end of the call. And I've asked people who go on past the usual time of the program, which is 6 months. I ask them, why do you keep coming back? And they're like, dude, every time you have a workshop on a Thursday, we get another candidate for our portfolio. Why wouldn't we come back, right? We have our screeners. We have option lookup tools. We have all sorts of data feeds. And we even have some short courses, things like that. We even have this download center where we've got all sorts of tools and indicators that you can use to help you in your planning. All right. So what would that all, let's see if I can there it is. The video tutorials. What's that worth? I'll let you put your own value on that. The monthly live classes and their replays, the lecture, all the screeners for finding the candidates, all the planning tools that you can download to actually do all the, calculation of risk and position sizing, the weekly live workshops and their replays. I didn't even tell you about the trade review. It's a 6-month program, but most people pick it up in the first 1 or 2 weeks. So then what do you do for the rest of the 5.5 months? Well, number one, you attend the weekly workshops, right? Right here. I put a line in the wrong place. You attend these weekly workshops, but the other thing you do is when you plan out your own trades, you send them to us and we review them before you put your money down. I want to look over your shoulder like I do with my, underserved foundation participants. I want to look over their shoulder for, a certain amount of time, just making sure they get it right so that you practice. And when I set you off on your own, you know, you go and you do it and you're successful. I don't want to leave you hanging. So what's all that worth to you? Because I'm also going to give you, for being on this call today, a double your money back guarantee. If you get to the end of the 6 months and you're not making profit doing what we teach you, then not only am I going to give you all your money back that you paid for the program, I'm going to double it. That's how confident I am. And I'm going to give you one of our coaching sessions. These coaches of mine have seen it all over the last 15 years. So you tell them where you are and where you want to be at the end of the 6 months, and they'll tell you how to navigate from point A to point B as quickly as possible. So add that in, the double your money back guarantee and the bonus strategy session you're getting for being here today at David's workshop. What is that all worth to you? Because I'll tell you, if you go on our website, it's $597. It's about $100 a month for the program. And you can split that up into payments. It's a flat fee. I'm not going to ask you to continue on. Like I said, a lot of people do because they like those Thursday workshops, and they also like the trade review. Yes, covered calls can be done in your IRAs. But there's no other charges that we're going to, for today, and only today, for you guys that are in the program, that are here at David's event, I'm taking $100 off. So this is how you do it. You go to optioninvesting.org/synergy. Here's a QR code. You can just take your camera and you can scan that QR code, and it will bring it up on your mobile device. And you have to put in the promo code. And a lot of times the people who set up my speaking events don't do it right. So let's test it. So optioninvesting.org/synergy. That's where we are right here. And let's put that promo code in, 100, capital D, capital I, capital S, capital C. That stands for 100 discount. And they did do it right. $497. That's where I want it to be. That's going to be good for today. If you have any sort of problems, you're welcome to give us a call, 970-266-8146, and we'll process your order over the phone. And again, it may not be a fit for some of you, but for others of you, this may be exactly what you've been looking for, especially heading into the holiday season. So I just want to let you know I'm here. And let me see if there's any other questions. Selling covered puts. Yes. Selling covered puts. That means you either have to short your symbol for the covering, right? A covered put, the shorting symbol is the covering symbol is to short a stock or short an ETF, or you could buy a deep in the money, far out in time put option, and then that'll cover selling puts. And then I answered it very quickly, but Moses asked, can covered calls be done in IRAs? Yeah, remember I gave you that chart that said which one were cash trades? You can not only do the covered calls, you could do the bull call diagonal debit spreads. In other words, the covered calls on steroids, the supercharged covered calls, and the supercharged covered puts in your IRA. I'm not located in the Chicago area. My company was established, and the main office is right outside of Denver in Fort Collins, Colorado. That's actually where we started the charity, was right outside of Fort Collins, Colorado, actually right outside of Denver in a place called Thornton. But we have since moved because I did so many speaking events at the CBOE, and I got to know those folks, and they said, hey, we'd love to go halvesies on your foundation if you help us here. The CBOE turned into a very electronic trade. It used to be so active, and now you go in there and it's just a bunch of people being very quiet and a bunch of computers.